Welcome to the Finance Geeks podcast with Paul Cleworth and Warren Shute. Two financial planners shoot the breeze while sharing tips for making the most of your money and living your best life. Expect a lot of laughs and genuine insights that might just transform the way you look at your finances. Remember to follow, like, and subscribe to the show. And now over to the geeks in the studio. But they are not in a studio. They are geeks in their own office.
Hello and welcome to episode 6 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute and I'm here joined by
Paul Cleworth.
And today we're talking about planning for the unknown. So Paul, what have you been up to this week?
What I've been up to? More karting. Oh my lord. We are now getting really involved with the race team ADX at Rye House. Rye House is where Lewis Hamilton started his career back in the day. And my son's very excited about getting his own kart and ride in a junior kart this time, going at like 65 miles an hour. So it's pretty terrifying. But I put a link in the show notes to ADX. I've been in a kart, but not one that fast. Maybe it's half as fast. And I watched a video just this morning with Kevin, my power planner, my wife had sent me, and it shows this kart doing a lap at 36 and a half seconds of the track. And it's going, 60 plus miles an hour. And it is terrifying. Can hardly see where the turns are. You can imagine doing F1 or something.
So what's your wife like about it? Does she worry?
Well, no, try not to worry about it. We get him all the protective gear and, he takes his time. He's got some good instructors. But it's exciting and he loves it. I've also been really busy this week, as I'm sure you have, end of tax year. We talked about it last time, but geez, I cannot wait till it's the 6th of April. It's just lots and lots of busy. And then it'll be new ISAs and topping things up. So never stops. But I am going on holiday at the end of today, actually. We're going down to Cornwall for a week with my in-laws and taking the dog, which is fun. And the last thing, I've been mowing my lawn. We had a full day of sun last weekend, and I spent about 4 hours on my sit-on lawnmower, which I loved.
Did you listen to the Finance Geeks podcast?
Did I? Yes, absolutely. That's all I listen to constantly while I'm mowing the lawn with ANC on my headphones. 4 hours. I listen to everyone, everything I've ever done. Yeah, absolutely. It's just mostly for your voice, really. But my son Miles rocks up in my Ego. I've got 2 sit-on lawnmowers like you do. One's a big big diesel Izeki 326, massive thing. You could do a football field with it. And the other one's, which I bought first, which was a sort of a mistake, is an electric one. And it's quite fast, and he's doing donuts on it. And I'm like, come on, that's not really helping. And he's driving it like a cart. Yeah. Anyway, Warren, what have you been up to?
Well, I am off. I'm on holiday this week and next week too. So it's Easter. I always take Easter off. We're not so frantic around tax year.
Happy Easter, by the way. Hey, happy Easter.
Thank you very much. My favourite time of the year. Easter generally far beats Christmas for me because the weather generally is a bit nicer. People are less stressed and stuff like that. So, it's a great time of year. And it's my dad's birthday. So my dad was 99 yesterday.
Wow.
So, we had a nice birthday party for him and thoroughly enjoyed it. He's American and we FaceTimed his family in the States. And, it's good. And what I said to my wife is it's interesting with life. And I'm realizing it more myself. As we get older, it's more about just fun times and experiences than items. Because everyone's thinking, what should we buy? What should we buy? And it's really about just the experience of being connected, being together and having a great time.
So that was your present to him, just being there together in the room, family time and engaging with him. And you realise, as you said, it's just the most important thing. Family's the most important thing.
Yeah, no, it is. It is. So hot off the press. What's hot off the press this week?
We should do hot off the press, shouldn't we? Yeah. Okay. So this is really quite hot off the press. Some things more than others, but Daniel Kahneman has just died, March 27th. So yesterday. And for our listeners who may not know, he was 90 years old. He was an Israeli-American author, a psychologist, economist, and he's known for his sort of hedonic psychology of judgment and thinking. And he wrote a book called Thinking Fast and Slow, which we've done a book review on in May 2023, and I put a link to that in the show notes. But yeah, very influential. So you've heard of him. You read his book?
Yeah, of course. Yeah. Read his stuff. Yeah, I really liked his stuff. Yeah, very, very clever guy. Very clever guy. The thing that worries me is as these individuals that I've looked up to in follows and stuff are passing away, it just makes me realise that I'm actually getting older myself. And that's really what it's all about, isn't it? It's just like, we're all age, we're on this conveyor belt and we're not getting off. So let's make it enjoyable and have fun.
Absolutely.
I tell you who is having fun.
Go on.
Rupert Murdoch at 92 is marrying his girlfriend Eleanor, who's 68.
He used to be married to Jerry Hall, isn't he?
He did, yeah. And that is someone whose vision, his future, is bigger than his past. And we talk to our clients about this all the time. Make sure your future, and I talk to my dad about it too. Hey, Dad, look, we've got to have more dreams and aspirations than we do memories. Because once we've got more memories, that's when we're really getting old. So what are we looking forward to? So, he's obviously looking forward to a nice future with his new wife. And it's sort of.
And so you encouraged your dad to get a younger wife as well? Is that one of the discussions you had yesterday?
I think he'd probably like it sometimes.
Yeah. Trade her in for a younger model. Yeah, I'm sure he can find someone younger at 99.
There's got to be. I'm a great visionary, and I look at the future and I plan this up. But there's got to come an age where you think, actually, now I'm not going to bother looking around. Or I'm just going to settle and carry on what I've got. But at 92, I'm not sure Rupert Murdoch is thinking that way. So
I know. Good on him.
So, and some. Go ahead. You got anything else on that?
I've got a few other things hot off the press. So just on the 20th of March, the inflation figure in the UK was 3.4%. So it's come down quite considerably from the sort of double-digit figures of 2022. Again, just recently, the UK figures are out that showed that in the third quarter of last year that we sort of declined and we were in a recession. It was 0.1% fall in the third quarter, 0.3% in the fourth quarter. This year, January, it's up 0.2%. And with rate cuts, with national insurance, with slight reductions in tax and the new budget, I mean, the economy's slightly improving, but Britain's one of the slowest countries to recover from the effects of COVID-19, which is a bit of a geeky stat. The other couple of things, just before we go on, is there's sort of no stopping global equities at the moment. The S&P, the Standard & Poor's 500, is at an all-time high. It reached 5261. It's up 84% in the last 5 years. The Dow Jones is at 39,760, the highest ever. It's only got 30 companies in it, and it's an indices going 139 years. And the Nasdaq is at its highest. Its highest was 16,428. It's at 16,399. So I get the question from clients: is this a high point in the markets? And my response is: A, I don't know, and B, all the information is reflected in the price. So you've got to be in it to win it. You've got to stay invested.
That's such a you've got to expect the markets to pull back. Okay.
At some point, they will. I mean, they're up about 12 to 15% in the last 4.5 months, our models, the 100% equities. And so it's all, we talked about setting expectations in our newsletter this month. It's actually an email going out to all of our clients today. And it's very easy to have expectations of, okay, it's done really well recently, therefore it's just going to continue. It's done 10% a year. The S&P 500 has done something like 10 to 12% a year for the last 10 years. It's just crazy what it's done. The American markets but all the biggest companies are American. The Microsofts, the Avivas, the Microsofts, the Apples, the Googles and Teslas and so forth, the Amazons. So it's tricky. And I think that if you are worried as a listener about global markets, about markets dipping, you can either alter your risk profile and include more bonds for that sort of ballast, that downturn, for reduced volatility. You can reduce your allocation to have a bit more cash. Or if you don't need access to the monies for the next 7 to 10 years, just stay invested. Because if we do have a declines are temporary, markets will recover. And you'll make the mistake perhaps of selling out or changing risk models and then thinking, when do I change back? So my advice to all my clients is just, if you've got a risk model, stay to it, only amend it if you sort of need access to the monies very soon.
This isn't a podcast on investing today, but I tell my clients, expect the markets to pull back.
Yeah.
They're going to pull back. They've had such a great run. We're expecting them to pull back. And if I'm wrong, then what a fantastic thing to be wrong about. But we should expect the markets to pull back. They pull back. We have a negative year, 1 in every 4. They're normally down around about 15% or something like that in 1 in every 4. So, they've had a really good run. It wouldn't be unreasonable. I think the Bank of England said something today about the markets being overvalued and something like that. That's going to jitter people. But if we're wrong, great, let it carry on running. But I'm not going to change my asset allocation, just what's on the news or whatever, because we're investing for the long term.
That's knee-jerk reaction, isn't it? And, you talk about setting expectations. If your expectations are realistic or even, on the almost towards pessimistic, then you won't be disappointed.
Yeah. Absolutely. It's
very good. Anything else off the press for you?
Well, I think we poignant to raise about Princess Kate being diagnosed with cancer. She came out and was very brave and did that video recording. And she's very much in the public eye, and she doesn't have the privilege, basically, to just retreat and just be on her own and not have any scrutiny in the press and things. I understand social media, which I don't spend a lot of time on, but social media went crazy wanting to know. But it's that unknown. When we don't know about information, when there's that void, we really search for it. And we want that to fulfill our uncertainty, to be told what's going on. And I thought today would be a great show to talk about, planning for the unknown. So if heaven forbid something like that happened to you or a family member, how would you manage your finances? So with that, should we move on to the main focal point?
We should.
Okay, so I guess in reality, there are so many unknowns that you're planning. So as a financial planner, what we're trying to do, at Lexington, our fundamental point is that you never run out of money, period. Whatever circumstance, whether it's retirement, whether it's bereavement, whether it's an illness, a market correction, whatever it is, you never run out of money. And that encompasses so many things. And one of the main things it covers is illness. So how can we plan so that you can recover your finances through an uncertain time of illness? Now, I've got some interesting stats that I looked up. 3 million people in the UK are living with cancer right now. Someone is diagnosed with cancer every 90 seconds. Now, that blew me away. That was really surprising.
Goodness.
480 people die daily of cancer. And the average survival rate has increased from 1 year in the 1970s to 10 years today. And I think the way the medical advances are going, that's only going to increase over time. So there is a silver lining to this cloud. But it's obviously not just cancer. It's any illness that's going to derail your earnings potential. So I think the first thing that we would get clients to do, and we encourage all our clients to do, is something that we will live by as well, is to have an annual medical. So prevention is better than cure. And I think, if I'm honest, when I take clients from the private banks, so when we take a new client on and they're kind of finally seeing the light and they get disgruntled by the commerciality of a private bank of just selling them more and more higher expensive products, they come to us and it's a different approach. And what we're really looking at is them as a person and making sure that their family wealth continues and then passes down to the generations. But one of the things that we talked about is, when was the last time you had a medical? And you're having an annual medical. It's all right having this money, but we want to make sure we're healthy enough and fit enough for our lifespan and our health span to continue for us to enjoy it.
Well, that's taking responsibility, isn't it? For your health and it's being responsible for your family. So because everyone's circumstances are quite different, their age, their income, and so forth. If someone's got a considerable amount of money, their requirement to have protection isn't quite as great, because if they are sick, disabled, or unable to work, or diagnosed with what we call a critical illness or serious illness, they're not affected as financially as much. But if you're building your career, if you've got kids, if you've got mortgage, if you've got debts, if you don't have, a very, very adequate income protection or sick pay, as people call it at work, which might be 6 months full pay, 6 months half pay. If you don't have that, you are taking a risk, of course, that if you are sick, disabled, can't work for a number of reasons, your income might stop. And then you say, well, what am I going to do? How do I support my family and pay the mortgage, pay the bills?
Completely agree. And I think, we have a lot of potential clients listen to this program. But if you're a financial planner listening to this program, really encourage your clients to take a medical annually, because prevention is better than cure. And it can be so helpful in ensuring that you remain on track to achieving the outcomes that you want.
And where do you get your medical? Which one do you use? Use Wellman or something like that? Or
no, so I varied it. We vary it. So Nikki and I have one every year. We vary it. So we go down to Harley Street. We have a clinic down there that we use. We've not always used Harley Street. We've used Nuffield. We've had medicals for them. And then sometimes when it kind of like I feel that things are going on track and I've just had a full medical down at Harley Street, I'll also use a company called Blue Crest, who do general just sort of blood checks. So I get my PSA tested and my basics, blood sugars, cholesterol, things like that, done almost every 6 months, really, every year. But we have a full medical probably every other year and have one of those dropped in between the two.
And what does a full medical cost, approximately, if you're going to have one of those?
1,500 quid.
Wow. I mean, it's serious, isn't it? I mean, this is taking your health seriously. What's more important? I get it.
Yeah, you've got to look, how much you spend on your car, how much you spend on your holidays. If you've got children going through education, whether it's university or whatever, what you spend on that, your hobbies and things. What's more important? Now, I am the goose typically that's laying the golden egg for our family. I'm the breadwinner. So it's so important that we maintain our health and then keep an eye on our health. And if anything were to happen, I want to make sure that, I've got the heads up on it.
I've used Thriver and Medichecks to do blood tests and tried them both. They're fairly similar. You can, maybe it's for £100, something like that. You can get a sort of, maybe it's £150, an ultimate performance blood test, and they'll, what I did personally when I did it is I have a nurse come to the house and actually, I think I went into Boots and paid about 30 or 40 quid, and then you get a nurse take an intravenous blood sample, because it's quite difficult to do it yourself with a little thing that cuts your finger, and it's painful, and you don't ever get as much blood. But if you get 2 decent vials of blood and send them off, usually within a week you do get the results back, and it's not quite the same as seeing a doctor, of course, and getting, even though the doctor reviews the blood test and tells you a lot of your 30 or 40 different metrics. But I totally agree with taking responsibility for your health and looking after yourself. It saves the need for a very expensive cover in some regards.
I'm not medically trained, but I would probably make an assumption that if you have a full medical and everything's pretty much fine, it's unlikely you're going to need a full medical the following year. So maybe these blood tests that you can get, and we've done them the same, just have these, and I normally get my sugars and my cholesterol done with them, where you come through the post, you prick your finger, do the blood thing, send it off and do it that way. So I've not been to a pharmacy and had it done, but something along those lines. So after we recommended a medical every year, sorry, was you going to jump onto that?
No, you carry on.
We feel it's essential that you have an amount of money in the bank, liquid, to cover your emergency expenses. And we typically say about 6 months of your expenses. So making sure you've got about 6 months of your expenses in your bank. And a lot of people talk about 6 months of your income. It's not really 6 months of your income. It's 6 months of your expenses, because that's what you've got to cover. If you're off sick and you're self-employed, or your employer couldn't fund your salary, you've got some money in the bank to pay the bills, the emergency cash. And you hold that in a high interest account or a national savings account, something on those lines.
Yeah, absolutely. It's very common, isn't it? 6 to 12 months or 6 months, depends. But cash is the asset to utilize, because you don't want to be accessing, ISA monies, if the markets have taken a tumble, and then you need the monies. So once you've saved money, squirreled it away from your main bank account into a savings account, you can then, of course, take out various forms of protection. So you look at what you've got through your employer. Arguably, that should be seen as a bonus to some extent, because if you're made redundant or fired or move jobs, you don't have it. So having an individual policy is better. And we're talking here about being sick, disabled, or not being able to work. We're not talking about death here. So if the unknown happens, and let's say it's something like stress, depression, or a very serious illness like a heart attack or cancer or stroke, you have one of 3, ideally all 3 types of cover. You'll have income protection, critical illness cover, private medical insurance. How do you explain those 3 types of cover to your clients, Warren?
We start in a priority of order. We always start with income protection. So we want to make, if our clients aren't financially independent, and over the years, more of them are financially independent, but I remember in the early days, a lot of them weren't. And if our clients aren't financially independent, we want to make sure they've got some kind of continuity of income. And the way I describe it to my clients, they might say to them, I'll use topical figures here. Let's say they're earning $50,000 a year. I'll say, well, look, if you're offered a job, you're on $50,000 a year, you're quite happy. Now, if you're offered a job on $49,000 a year, but they'll pay your income if you're off sick, until you retire, which one are you going to opt for? The £50,000 a year where your income stops if you're off sick, or the £49,000 a year if your income continues? If you're likely to go for the £49,000 a year, then really all we're talking about then is an income replacement, an income protection policy that will pay out after 3 or 6 months. It will pay you a tax-free income up until you retire or the end of the product term. And it generally pays a percentage of your current earnings. And because it's tax-free, we can normally go for, say, 50 or 60% of your earnings. That is peace of mind. Nobody really wants insurance. Nobody really wants to put money in the bank. What they want is the peace of mind that it gives you. Knowing
that's what you're paying for, isn't it?
Absolutely. If I can't work, I've got a peace of mind. I've transferred the risk I've transferred the risk from me carrying the risk myself that if I can't work, what am I going to do? If I'm diagnosed with something like Princess Kate, I need some time out. I can't go to work. I need to concentrate on myself, my own health. I don't have to worry about working. I've got some income coming in, which is tax-free and is going to pay me to pay my bills.
Yeah, definitely. Interestingly, I had a look at the most common types of income protection claim, and there's a statistic in the show notes from Liverpool Victoria that shows that in 2022, the 5 most common reasons that people would claim for income protection, so that means they're sick and can't work, are 25% of claims are musculoskeletal, 20% of claims are cancer, 12% of claims are mental health, 10% for fractures, and 6% for COVID-19, which is, of course, quite topical still. And there are lots of providers that do this. And I think that I know what you're saying about income protection being one of the first types of cover that you might recommend. But I think that for our listeners, we should make sure that they understand there is a slight difference between income protection and critical illness. Insofar as you can have circumstances where they both pay, because you can claim on both. You can have circumstances where theoretically you could have a form of cancer that still allows you to work. And so, the critical illness cover might pay out a lump sum. It can pay a monthly amount under what's called family income benefit. And the income protection, if you're still able to work, might not kick in. They're quite expensive types of cover, tend to be more expensive than life insurance, which is less statistically likely to happen, as in you die. But in terms of order, it's whatever's most appropriate, I think. You could have a large lump sum paid, and which is more typical for if you're diagnosed with one of a list of like 30 or 40 illnesses, or a monthly income, or both. Because you might want, if it's very serious, you might want a lump sum to pay off the mortgage, and then you still need an income to live. So both types of cover are very relevant, aren't they?
Yeah, it completely, 100%. And I think as a priority for me, income protection tends to trump critical illness or serious illness, just because of affordability. It tends to be less expensive. And really what we're doing here is replacing our income. It's like if I've been diagnosed with a critical illness, but I can still work, psychologically I might be worrying, but I can still earn money. And sometimes keeping yourself busy is quite good. Whereas if I can't work, the problems start mounting up pretty quickly. And so you're absolutely right. The definition of income protection, it pays out typically if you're unable to do your own job. There are policies out there will say if you're unable to do any job or any suitable job, but a product that you really want is if you're unable to do your own job. So you've got quite clear definition.
Well, this is the thing. This is why some advice is required, I think, if you're going to take out policy like this, because it's not just about cheapest policy is best. You've got deferment periods as to how long it waits before it pays out. You've got the end period. And the deferment periods are usually 4 weeks, 8 weeks, 13 weeks, 26 weeks. And then it's usually to age 50, 55 or 60. If you get one that's level cover or indexed cover, indexed is better in inverted commas and it's more expensive. And as you said, if you get own occupation over any occupation, it's going to be a slightly better policy as well. You want to be with a reputable provider as well, that the claims history is such that they're going to pay out. I mean, we've had over the last 5 to 10 years, must be over a dozen clients claim on various policies, some income protection, quite a few critical illness policies, and unfortunately on death. And every single one has paid out. And I was surprised almost because some clients have had conditions where you think, will they satisfy the condition, the definition of the illness? The ABI, the Association of British Insurers, give a definition guide. And if you've got a really quality policy, it's a clear guide that's easy to pay out on. So, for example, it might be that 30% of the heart needs to be damaged if it's critical illness for a heart attack, whereas a poorer policy might say 60%. And you want to make sure that it's with a reputable provider. So in terms of how much you would recommend that people pay for protection as a percentage of their income, do you do that? Do you actually say this is how much you should consider?
No, I don't. What I'm looking at is we run the cash flow. So we look at the cash flow with assuming they can earn. Then we run a scenario assuming that they can't earn any money for whatever reason. And then we find out how much insurance they need for that. Now, a lot of the times they might need more insurance than they want to pay. So what we're trying to do is make a difficult situation better. So, a lot of the times, if you bought all the insurances that you needed, you'd have very little money left. So we're very commercial and pragmatic about it, but we want to try and make sure that there's something in place so that there's a plan. There's a plan now before the situation hurts. Have you got some kind of ratio that you use?
Yeah. So it's dependent on affordability largely, but it ranges typically when someone's perhaps over 50, where they'll be older, so the cover might be more expensive. It might end up being 4 to 6% of their monthly net income. And so, I do like ratios to give guidance to what I feel is appropriate. It's obviously different if you're younger and you want a £200,000 of critical illness cover, or 50% of your income, and you're only 25 and a non-smoker in good health. It's going to be relatively inexpensive. That's relative to one's income as well. And so what we might think is relatively cheap, others might think are expensive. But I would say definitely to anyone listening that you're just not going to get a quality policy for £10 a month. There are ways to make it cheaper. For example, Legal & General, a massive insurer, do a sickness and injury cover where it's called illness and injury cover versus income protection. And the difference between the two is it only pays out for 12 months. So you can get types of income protection where the best kind, ideally, are where it pays out until the end term, age 55 or 60, because you just don't know how long you're going to be off work. And you can have multiple claims with that policy. So when you go back to work, you carry on paying the premiums. And if you get waiver of premium, and you've satisfied the definition, it can pay the premiums for you. But the illness and injury insurance, it can keep the premium lower, have cover, but it only pays out for 12 months. So there's a risk in that. But the point is there's options in terms of getting the premium affordable, and it's better to have cover and understand what it's going to pay for than have none. So these types of cover don't pay for unemployment, for example. Yeah. If you're made redundant or made unemployed, they don't just kick in. It's if you're sick, disabled, or unable to work.
So you've touched on it already about critical illness cover or serious illness cover. There's two types of policy. We like those. We don't do as much probably as a lot of other people. Probably because of the cost behind it. But you do a lot of critical illness policies? So
not a huge amount. I definitely used to do more when I used to do mortgages, because they go hand in hand, types of income protection. If you've got a debt, you've got a reason to have cover. And so if you start to get to a point where your average age of client that we work with is 57, a lot of them have paid off their mortgages, or they've got assets such that they don't really need a lot of critical illness cover. It can get to a point where if you're older and if your health's a bit worse, that the cost of it can be counter effective. Let's say, give an example. Someone's 45, they've got a mortgage, they've got kids, they're married, they've got debts, they've got an income of £50,000, £100,000, whatever it is. It's not unusual to have £250,000 to £500,000 of critical illness cover to age 60 or even 65. And the main types of claim are cancer, heart attack, stroke. Almost always, it's one of those three. But they have, some of them, 45 illnesses and different definitions. So the important thing is you've got to understand that it's applied for at the point of it's underwritten at the point of application. And so if you do a proper medical and you get the GP report and you get a policy that says, right, you are covered for these illnesses, as long as you've not lied on your application form and said you're a non-smoker when you are a smoker, if it comes to a claim and you satisfy that definition of the illness, you'll get paid out. Yeah. And so, there's little tweaks. You can have life or earlier critical illness, so it pays on the first event. I do a lot of for clients that have got debts or are younger, we'll do critical illness, but I think more often than not, we'll have life insurance for a lot of clients. It's more popular. 50% of the policies we'll write will be some form of life insurance that pays on death. What about yourself? Do you do any private medical insurance for clients as well as income protection? Do you ever do any of that? We should get onto that.
Yeah, sure. So, and then the third insurance really, which we're moving on to now, is the medical insurance, private medical insurance. So we've covered the income protection, which covers your income in the event you've been unable to do your work, whether it's your own job or similar job. We've got critical illness that Paul's talking about, which is paid out in the event if you're being diagnosed with a listed critical illness. And then the third type of insurance is medical insurance. Now, this really covers the cost of treatment, whether it be in a hospital or an outpatient, for any kind of medical condition. And we do a lot of this. We do a lot of medical insurance.
Who's your preferred provider? Who do you like to use?
Bupa and Vitality generally to be the main sort of providers.
Do you know, there's over 10. Bupa, I think, is synonymous with private medical. I think a lot of people know the name and they've got a very good brand. AXA, PPP, it's just basically AXA now. Aviva do it. We actually have my policy with Aviva, Saga, Vitality, Exeter, Alliance, WPA. There's quite a few that advisors, even if they're independent advisors, can't use. It's quite a specialist market. But you're right. It's getting a policy. There's lots of options with these types of policy. Different hospitals, different types of cover. You can add in psychological cover, travel cover, dental cover, lots of things. But inpatient and outpatient care, again, slight difference there in terms of what it pays. But a quality policy where you can add your children if you want, and it's paid and properly underwritten. When you do policies, Warren, do you do full medical underwriting, FMU, or do you do the moratorium?
No, 99% of the time FMU. So what Paul's explaining there is there's two types of way you can underwrite a policy. One is where it's like a life insurance policy. You disclose all your medical information and they then come back and say, we're going to cover you for all these things, but we're not going to cover you for this. And the other one is called a moratorium basis, where they look at your past or any significant claims you've had in the past, and they'll exclude them for either for the policy term or for a period of time going forward. So it's a little bit grey in my world of what you're actually covered for. Also, fully medical underwritten, the premiums tend to be a bit cheaper as well. So that tends to be our preference. With all insurances, we want real clarity so the client knows, okay, I'm going to get paid out if this happens. Full underwriting helps with that.
Yeah. Do you know statutory sick pay, for which there's a link in the show notes, is only £109.40 per week. And it's if you're too ill to work, and it's paid by your employer for up to 28 weeks. And so if you've got an employer where your contract for employment says that you get full pay for 6 months, I mean, that is pretty incredible. That's excellent. That's unusual, I think. I mean, civil servants, teachers, may get that sort of cover written into their policy, into their contract. That's a good benefit. But more often than not, it can be spurious in terms of what it says. It might be 3 months, and then we'll take a view, and then it's sort of it jumps to statutory sick pay. So if you're off work for a long period of time, you can have your income protection policy kick in perhaps after your employer start to reduce their cover. So if your employer gives you 6 months cover, get an income protection policy with a 6 month deferment. It will be cheaper to get that, but then of course you're protecting yourself for the long period, for the long term.
It's no, you're absolutely right. We're kind of jumping around a little bit. We might be confusing the listener a little bit. So we've gone from medical back to income protection. But with medical insurance, I think the main thing is you ask yourself the question: are you happy being treated by the NHS and having their waiting times, or would you rather pay for it and have insurance privately? It's not I've got clients who are extremely wealthy who say, no, the NHS have looked after me all my life. It's a very good institution. I'm going to rely on them going forward. Yeah, I have other clients who may be starting out a business, starting out new. They're more entrepreneurial, saying, well, actually, no, Warren, do you know what? If I get sick, I need to be seen really, really quickly, get it sorted so I can get back into work, because I can't afford the time away from my business. And
my experience with private medical, because we've had clients that have claimed, and myself and my wife have claimed once in the last 10 years for ourselves or our son, and it's I think it's a little bit luck of the draw to some extent, because it's often not often necessarily, but sometimes the same specialist that sees you. They might be working for the NHS and they might see you on private medical. The biggest benefit, the two biggest benefits as I see it to private medical, you theoretically should jump the queue and not have to wait on an NHS waiting list, but it doesn't mean that you're going to get seen immediately. So anyone thinking, I'll just get private medical, I'll pay for it. It's like, this House, the series in America, where, Hugh Laurie just has someone in and they do all the operations and all the tests the next day. That is not what happens in the UK. You still have to go through a process and a system and a claims process. They provide the in and outpatient care costs are covered to an extent. There are still some policies and still operations that are not fully covered. It's not like a blank checkbook that everything's covered. So, you do have to read the T&Cs in your policy to make sure you're with the right provider for you and that you understand the claims process and so forth.
Yeah. I think really what it does is it gives you peace of mind that you most likely are going to get seen sooner, and therefore get treated sooner, and therefore get back to work sooner, or get back to your day-to-day living. But
there's clients that we both have, and I too come to mind with myself, where the premiums now for them, when they're in their 60s, are so expensive, like £750 a month for each of them, £9,000 a year. And they're asking me the question, which I understand why they would ask it, is this value for money? Should I keep it? And it's not as easy to just change providers, because when you change providers, you might lose the existing cover that you've got. They might not cover it. It's not an easy thing. So a lot of people stick with the same provider. But, if you consider how much that is per annum, what illnesses are you going to have that are going to cost £9,000. If it's a specialist type of cancer treatment, it might cost 10 times that. You might have to fly somewhere, go somewhere. And obviously you're always going to, even if you've got the money to cover it, it's tricky to jump the queue. And again, that all costs money to find a specialist cover. You mentioned Harley Street before. I mean, that says a lot about you, A, that you can afford to go to Harley Street, and B, that you take responsibility, you take it seriously, and you want to go and pay for it. And if that's your motivation, you want to do it properly, do that. You've got to weigh it up.
It's not that I'm particularly wealthy or anything. It's just that I believe in life you get what you pay for. There are some very good financial planners out there, and there are some very average ones. And if I'm a client, I want to go and see a very good financial planner.
Do you know any good financial planners?
I might know one or two. It's but it's the same with doctors. It's like there are some excellent doctors out there, and there are some that are less good. And I want to see the excellent doctors. And sometimes I want a second opinion. And I do. My daughter's had an operation. I researched the doctor. Just because we was referred to a consultant, I looked into the consultant to make sure it was the right consultant for my family. And I think in the UK, this is less common. But in the States, you get second opinions and you investigate your doctor and stuff like that, make sure it's done properly all the time. That's important to me.
So should we sum up then, Mr. Shute? About planning for the unknown.
Absolutely.
You tend to be quite good at this. Go on then.
So I think the first and foremost is that everyone really does need some money in the bank, whether that's 3 months of your expenses, 6 months or 2 years, whatever it is for you. It's a sleep well at night factor. It's not an investment. It's an insurance. Okay. Premium bonds, national savings, or money in the bank, wherever you want to keep it, but instant access, you'd have such your investments. Then we're looking at, what risks are to my financial well-being? And there are 3 main types of insurance you can consider. The first one is income protection. This pays out a replacement of your income or a percentage of your income, tax-free from the moment of the claim all the way through until the end of the contract or whenever that might be. There's often a waiting period, and that could be anything from 1 month to 12 months. So depending on how much money you have in the bank would dictate on how much of a waiting period you want. And really what we're looking here is if you're unable to do your job through an accident, sickness, or something along those natures, it's not redundancy. So that's the first insurance. The second insurance is critical illness cover, also referred to as serious illness cover. And this pays out typically a lump sum, but it can pay an annual payment on diagnosis of a listed critical illness. And this really can be a little bit more expensive, but gives you very much peace of mind, especially if you've got a mortgage and you want to make sure that debt's repaid if you're in your accumulation stage of your life. And then the third insurance we touched on was medical insurance. Private medical insurance allows you to see a consultant or a physician privately to go and get your diagnosis. You do have to get a referral from a GP. You can't just go in, rock up. And it will hopefully help you get seen quicker and more faster rather than going on the NHS waiting list. There is an excess for your claims. You still make a payment towards your contribution towards treatment, but generally that's a few £100s rather than thousands of pounds.
And having all these types of cover, ultimately, if you decide to have one or all of them, ultimately gives you, as we've said, peace of mind. It allows you to not need to worry about these things necessarily, because if the worst does happen, if the unknown happens, that you've got something in place, you've got a bit of cash in place to help, and you've got some policies in place to help pay and replace your income and pay down debt or pay it off. And so, it's we always say, working with a financial planner is largely about controlling your behavior and helping you achieve financial independence and financial freedom. And these are tools to have. These are policies to have whilst you're growing your wealth. And even when you get to a point when you're 60, 65 and you're maybe drawing down income in the future, some of them are still relevant. Private medical might be still relevant. You might say, I still really want that cover because that's important to me. And if that's the case, then have it. But do, as I say, take advice or do at least read all of the T&Cs to make sure you get what you pay for.
So I think what you do there is you summarize my summary.
I was trying to do it more succinctly, I just think there were bits that you missed, that's all. I was just trying to make sure it's not the Warren show today. Mr. Warren, should we move on to 2 pennies worth?
Let's move on to 2 pennies worth, Paul. So, do you have a 2 pennies worth to start with?
I got two. Got two today. Got two, yeah.
Two.
Two. So number one is a book, it's called How Will You Measure Your Life? and it's by Clayton Christensen, and we did a book review on this in January 2022. There's a link in the show notes, but quite interesting that he talks about how you can find meaning and happiness in your life, and we touched on this in previous podcasts, and how you can be sure one day that you'll look back on your years confident that you've spent them well. How do you do that? And I really like it. I mean, this chap's a world-renowned expert on, and he's a Harvard Business School graduate, and he's used academic research to look at how people live their lives, what's important to them, where they find and derive happiness, and are they living their best life? And it's I think it's great because he makes you focus on your key relationships and think about what's important to you. And I know that you're quite passionate about this as well, Warren. But the book in itself, I thought, was quite morbid at first with the title. How will you measure your life as if you're on your deathbed? But it is important to think time is finite. Life's for living. Yes, you have to save for the future and plan for it and protect against the unknown. But actually, you've got to live with purpose every day. And as you say, live life by design, not default. I listen. The second one is an app which I really like called Headway. And again, the link is in the show notes. I've actually finished 41 books using this app. That's because I listen to them on my dog walk, and you can read them, but if you listen to it, they're usually sub 15 minutes. So it's kind of like Blinkist, which is another app which I've put in the show notes, which is similar, very, very similar. It's kind of like having the York Notes or the Cliff Notes, as they say in America, where you get the summary of a key book. And so there's loads of great books, and some books take you a week to read. You can read others in a day or two. But if you want to sort of, in effect, read the book in 15 minutes and get all of the key bits, you can listen to Headway, and it's really quite good. So those are my two Pennies Worth. Yeah.
Okay. So I've got a film for us this week.
Great.
The film is called One Life. Have you seen it?
It's a series, isn't it? Isn't it a series or a? I've seen it. It's based on a book, isn't it? And it's on. What's the day now that they do it? It's on a special St. Swithin's Day, July 15th or something?
Okay, not that.
All right.
Okay.
Is that something else?
Yeah, it's a film by Nicholas... it's a film about Nicholas Winton, who saved 100 children before World War II.
I'm thinking of one called One Day. One Day. Sorry.
I was thinking, it doesn't sound like that, Paul.
But that was good as well. Watch that one. I think it's called One Day.
One Day.
Okay. Yeah.
I'll make a note of that. It's called One Life, anyway. A film about Nicholas Winton, who saved 600 children before World War II from Prague, who now count for over 6,000 people are alive thanks to his efforts. So, it was really good. Yeah, very moving. Very, very interesting film. So that's One Life, not to be confused with One Day. Completely different.
One day I'll not interrupt you or comment unnecessarily. I'll get it wrong. One day I'll get something right. Yeah. Do you know there was a funny meme that my brother sent me, and I have to state it because it is quite funny. It did make me chuckle. So it was a little meme that got sent through to me. Let me just have a look for it. This is it. I'm going to put it on the screen on here. Right. So I don't know if you can see this. Yeah.
For the last 28 years, all you've done is find mistakes in anything I say. 29 years.
So for our listeners, there's a guy looking at his wife going, for the last 28 years, all you've done is find mistakes in anything I say. And then she says 29 years. And it did make me laugh.
That's very good.
Yeah.
That's very good.
Yeah. Can't do anything right. This is it. Yeah.
How about your Q&A this week? What have you got?
I've got some quotes. Yeah, I love quotes, as you probably know. So I've got 3 quotes. Yes, excellent. Right. So the first one is this, right? If all the economists were laid end to end, they'd never reach a conclusion. And that was said by George Bernard Shaw, who was an Irish playwright. And I was just talking earlier on about those the statistics and inflation and interest rates and what's going on with markets and all of that. And there's all these predictions all the time. And I like listening to this quote or reminding myself of it, because the fact is, if all the people that invested all the money, the pundits and the journalists, knew what they were doing and were always right, why would they be helping anyone? Why would they tell anyone? They would just do it themselves. There was another saying about an economist. Who was it? Was it Richard Nixon said, I wish there was an economist with one hand, with one arm, so he'd never say on the other hand. Anyway, there's the second quote, which is, the real measure of your wealth is how much you would be worth if you lost all your money.
Oh, I like that. I like that one.
It's by an unknown author. The real measure of your wealth is how much you would be worth if you lost all your money. So if you're defined by your money, your position, your status, your power, and all of that went away, I mean, this is referring to wealth and money, you should be more than that to your family, your friends, yourself. You can only be a better person than you were yesterday. So we talk about expectations, striving for the future. Just try to be a better person than you were yesterday. Simple. Number 3, this is one to do with our topic today on planning for the unknown, and it's by an enslaved man called Thomas Fuller, who lived between 1710 and 1790. He was called the Virginia Calculator, and he was a maths prodigy. Anyway, he said, apparently, because it was over 200 years ago, he said, health is not valued till sickness comes.
Yeah, I can agree with that.
You can have all the money in the world, but if you haven't got your health, you've got nothing.
Yeah.
So look after yourself, look after your health, take responsibility by, this sounds very preachy, doesn't it? But it's just reality by looking at, living with care and due diligence. And, what did my dad say? Everything in moderation. He's doing all right. He's 87 this year. Everything in moderation. That's it in a nutshell. Yeah. But it's true, whether it's food or alcohol or whatever it is. What about yourself, Mr. Shute? What have you got for us?
I'm just going to give you one this week, and I'm going to say knowledge is surrounded in consciousness. That's by Maharishi, the founder of TM, Transcendental Meditation. So,
deep, very deep.
Knowledge is surrounded in consciousness. But on that note, should we wrap it up for the day?
Yeah, I think so. So thanks everyone for listening. Warren, you do our sign off. Come on, get with it.
Okay, I think that's a wrap for today. Thanks for listening. Please like, share, and subscribe to our podcast. Do leave a comment and any questions you may have, and we'll cover those in future issues. See you next time, everyone, and bye for now.
Goodbye. Have a great day. And happy Easter.
Happy Easter. Enjoy the eggs.
Thank you for joining us for today's discussion. If you're enjoying this show, please subscribe to our podcast. It's a great way to support us. If you have questions or comments about this podcast or topics you'd like to suggest for the show, please put these in the comments section on YouTube. Remember, if you find yourself humming our theme song for the next week, it's not a sign of brainwashing. It's just a testament to our awesomeness, or possibly a mild earworm. Consult a doctor if symptoms persist. This show is designed to be informational only and does not constitute investment or financial advice. Please contact a regulated financial advisor before taking any specific action.